Welcome to the Riskwiser Zone, the podcast where we dive into the world of stocks and finance to help you make informed decisions about your investments. As we approach the end of the year, the stock market is giving investors a Christmas gift: new records for the Dow and S&P 500. On this abbreviated holiday session, the Dow led the way with a 0.60% gain, while the S&P 500 closed at a record high of 6,922%, up 0.32%. The Nasdaq also saw gains, rising 0.22%, and the Russell 2000 reversed some of yesterday's declines, closing up 0.22%. But what's driving these gains? Is it just a Santa rally, or is there something more at play? We'll be taking a closer look at the market trends and economic data to help you understand what's happening. In today's session, we saw some big movers, including Edgewise Therapeutics, which rose over 25% on news of its completed Phase 2 trial for a clinical-stage heart disease drug. On the other hand, some retail stocks fell back to earth, with AST SpaceMobile, Hycroft Mining, and D-Wave Quantum leading the declines. We also got some economic data, including jobless claims, which showed a mixed picture. Initial claims declined, but continuing claims rose. What does this mean for the overall economy? We'll be breaking it down and exploring the implications for investors. As we head into the holiday season, it's essential to stay informed about what's happening in the world of finance. We'll be keeping a close eye on market developments and bringing you expert analysis and insights to help you navigate the risks and opportunities. We'll be right back with more from the world of stocks and finance on the Riskwiser Zone. Welcome back to the Riskwiser Zone. We're diving into the world of economics and finance, where the plot thickens by the minute. Today, we're focusing on Japan, a country with a storied history, vibrant culture, and an economy that's always worth keeping an eye on. Now, let's talk about Japan's latest budget approval. The cabinet, led by Prime Minister Sanae Takaichi, has given the green light to a record 785 billion budget for the next fiscal year. That's a significant increase from this year's initial budget of 137 billion. But what's interesting is that despite this substantial spending plan, the government is vowing to keep debt in check by limiting new bond issuance. The budget breakdown reveals that tax revenues are projected to rise 7.6% to a record 538 billion, which will help fund increased spending on social welfare and defense outlays. However, debt servicing costs for interest payments and debt redemption will jump 8% to 253 billion, with the assumed interest rate set at 3.0%, the highest level in 29 years. This is where things get fascinating. Japan already has the highest debt burden in the developed world, with a debt-to-GDP ratio of over 200%. This makes it highly sensitive to rising borrowing costs and complicates Takaichi's plans to pursue aggressive fiscal stimulus measures. It's a delicate balancing act indeed. The industry ministry is also set to nearly quadruple its budgeted support for cutting-edge semiconductors and artificial intelligence development to about 7.9 billion for the fiscal year starting in April. This comes as Japan tries to strengthen its capacities in frontier technology, amidst a backdrop of tense relations between the US and China. Now, let's take a step back and look at the bigger picture. Japan's economic landscape is complex, with many moving parts. While the government's efforts to stimulate growth are laudable, the risks associated with rising debt levels cannot be ignored. As investors and market watchers, it's essential to keep a close eye on these developments, as they have far-reaching implications for the global economy. In conclusion, Japan's record budget approval is a significant event that warrants attention. The government's commitment to fiscal discipline will be tested in the coming months, and the outcome will have a ripple effect on markets worldwide. As we always say here on the Riskwiser Zone, don't bet against the market, but do stay informed. Welcome back to the Riskwiser Zone. As we wrap up today's show, I'd like to delve into a fascinating topic that's been making waves in the world of technology and employment. The rise of artificial intelligence, or AI, has been a game changer in many industries, but it also raises important questions about its impact on jobs and the future of work. We've seen how AI is being used to generate resumes, screen job applicants, and even conduct interviews. In fact, research suggests that AI interviewers can lead to increased job offers and improved retention rates. But as AI takes on more tasks, there's a growing concern about its potential to replace human workers. Some experts argue that AI is not replacing jobs, but rather augmenting them. It's automating repetitive and mundane tasks, freeing up humans to focus on more creative and high-value work. However, others point out that the rise of AI-generated work slop, low-quality content that masquerades as meaningful work, could lead to a new set of problems. It's also worth noting that while AI may not be directly replacing jobs, it's often being used as a scapegoat for layoffs and cost-cutting measures. CEOs are quick to blame AI for job losses, but experts say there's little evidence to support this claim. As we navigate this complex landscape, it's essential to approach the topic with a nuanced perspective. While AI undoubtedly presents opportunities for growth and innovation, it also raises important questions about accountability, transparency, and the need for workers to develop new skills. So, what does this mean for investors? As you consider investing in companies that are leveraging AI, remember to do your due diligence and assess the potential risks and rewards. Look for companies that are using AI responsibly, with a focus on augmenting human capabilities rather than replacing them. That's all for today's Riskwiser Zone. Remember to like, share, and subscribe, and until next time, keep your finances in check.